Isn't that fascinating? We live in a system where everybody that's working hard, that's saving money, is forced to become an investor. And we are all buying into the lie. Just buy a part of the economy and long term you will make money. And the lie is very convincing. This is the S&P 500 over the long term. This chart starts in the 1980s and it tends to go up over time. But the story that nobody is telling us, that this line going up is not a reflection of the economy doing well. Because why then is a shiny piece of metal, the gold price, going up just as well? Yes, there is geopolitical conflict right now. There's a lot of uncertainty. People look for safety. But I'm not talking about the day-to-day here. I'm talking about the long term. This here is the US money supply over time. And it grows by 6.8% per annum. The real reason why all the prices are going up, why houses go up, why stocks go up, why gold is going up, is the US dollar going down in value over time. And so because of that devaluation, everybody is forced to become an investor. Everybody is forced to get rid of fiat currency and put this into something else. Now, I think that the system is intentionally designed that well. There is even an inflation target of the Federal Reserve, right? 2% inflation. The target. We measure officially around 3% per annum, and we actually have a debasement of 6.8% per annum. We are forced to participate in the game, and the people that are very deep in that game, that have learned the game, they are able to outperform the market. This here is the S&P 500 relative to the money supply. So we are not looking at the US dollar price of stocks, we are looking at the performance if there was a constant monetary base. This is a long-term chart. It starts in 1959. And there are very long periods where we don't gain any purchasing power at all versus monetary debasement. This here is 36 years of data. This, by the way, is when Bitcoin got created. And the dotted line here, that's the average ratio of the S&P 500 to the monetary base. So sometimes stocks are expensive and sometimes they are cheap. Now, the problem with stock valuations is that we can't really know how technological progress will play out. In other words, will artificial intelligence really replace a lot of the office work in the next? If we don't need anymore millions of workers in office towers that are typing away all the time and this is all automated, then the owners of the technological infrastructure, of course, will make a lot of profit from that automation. Maybe the office worker will get replaced in a similar fashion how the farmer got replaced 100 years ago. It's hard to say whether or not stocks are currently expensive, but with the gold price, it might make sense to bet on the trends. Because the volatility is massive, from top to bottom, the gold price underperformed the US money supply by 90%. And here, this rally from bottom to top, that's more than 850% of gains. And again, it can take a very long time to get purchasing power back. This point over here to this point over here, that's almost 40 years of data. So wouldn't it make sense to try to take advantage of that volatility? So instead of just being completely passive and allocate towards gold and allocate towards the S&P 500, if we already have to enter the investment game, money devalues over time, shouldn't we bet on the asset that's comparatively cheap, not bet that much on the asset that's comparatively expensive? Shouldn't we try to buy more gold over here and buy less gold over here? Now, there's a very straightforward way to time trends. We can use moving averages. We could, for example, sell over here and buy back over here. Sell over here and buy back over here. But when we follow that strategy, what's the best moving average duration? Is it this line here, or should we take a shorter duration and take this line instead? Or maybe even shorter and take this line instead? Then we buy very, very early and we sell very, very early. But we also have our little failed signals. So is this better to follow the trend, or is this better to follow the trend? Because that then answers at what point it might make sense to rather be cautious with the gold investment. Again, the target here is that we don't want to hold an asset that's going down for more than 20 years relative to the monetary base and then lose a majority of our purchasing power. Now here's Bitcoin Strategy Analytics, the backtesting platform of this channel. And we can backtest all kinds of assets. We can look at Bitcoin, but we can also backtest gold, for example. And instead of just backtesting the gold price, we can backtest this relative to a ratio. So let's say gold relative to US M2. I've already done that analysis. Here's the single indicator optimization. We try to find the best simple moving average. We can use other indicators, but that's the most straightforward one. The data starts in 1959. That's also when this chart here starts. And here is the daily moving average. Now I checked all the moving averages up to the 200-day, and interestingly enough, the longest duration was the best. And so maybe instead of using the daily moving average, why not use the weekly data? So that's a tick over here, and then we get this chart. The best weekly simple moving average for the gold to money supply ratio is the 142 week SMA. That's the best to time the market. Now, how much of a difference does this make? While the gold price only slightly outperformed monetary debasement during the time, so by 0.89%, so that's this move over here. When we use that trading strategy, so when we follow the trends, we are making an additional return of more than 4% per annum. Now that's when we go long and cash. In other words, we sell gold over here, we buy it back over here. We are not betting on falling prices at any point in time. If we do bet on falling prices though, we can even extend the alpha slightly by another percentage point. But that makes the situation a bit more complex. Let's just go with the simple strategy. We buy and sell gold. And of course, when we sell gold, we can potentially put this into other assets. We can maybe put this into property or into stocks, maybe even fixed income. So it's the 142 week simple moving average in gold. Here's again that chart, gold relative to the money supply. And what we see here in blue, that's when we are in cash, when we simply have fixed income. And when we are in blue, that's when we are in gold. You can see how the strategy measured in gold is going up quite consistently. So let's plot the gold price with the 142 week simple moving average. So we select the weekly ticker over here. We add the simple moving average. We've got the length of 142. How much risk is there that we potentially enter a bear market in gold? How low could gold potentially fall? The answer is 34%. If gold was to fall by less 34%, then we might still be in a bull market. But again, there are sometimes wrong signals, as we had in October of 2008. So no approach is perfect. That's why we do the backtest. We try to find what's historically the best approach. And this gives us an idea to how to potentially beat the market. Now, in a system where we are forced to invest because the value of our money goes down over time, because the Federal Reserve is printing new money left and right, when we are forced anyway to buy something, we might as well buy the thing that currently has positive momentum. We might want to sell the thing that has negative momentum. There are ways to beat the game, but they're not obvious. Just looking at US dollar prices, even on a logarithmic scale, doesn't really give us a good hint when something is expensive or when something is cheap. But once we compare with the monetary base, we get a much cleaner picture. We get the average ratio, we get a potential equilibrium. Going down to that equilibrium means the gold price falling by 43%, but we might already be in a bear market once we fall below that moving average, the 142 week simple moving average. Of course, every week this level going higher and higher. So as long as we just go sideways with the gold price, might be able to take profit a bit earlier. If you got some value out of this video, feel free to give it a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. If you're interested in doing your own back tests, or if you want to see what kind of strategies I've developed using the back test, then feel free to check out the premium membership. Link is over here. Looking very much forward to seeing you in premium as well. Thanks for watching. See you next time. Cheers.